Welcome back to our intermediate financial accounting class. Over the last few segments, we've been talking about changes to retained earnings and what different changes in our accounting methods or accounting systems affect the retained earnings numbers. We've talked specifically about changes in estimates that affect this year's retained earnings number through closing entries. We've talked about changes in principal that affect retained earnings by actually changing previous retained earnings amounts and also changing this year's numbers. We've started talking about changes in entity, and we don't get to talk about the big entity topic, which is consolidations, but we do get to talk about transferring stocks out and into the equity classification. And we've wrapped up our discussion of transferring stocks out of equity, which means now we need to talk a little bit about what happens when we transfer stocks into equity. And we're going to break it down again into 3 steps. Now, these steps assume that when the company buys the first round of stock in this desired subsidiary, that they won't quite get up to the 20% threshold. So the first thing we have to do is we record the purchase of this stock at less than 20%, and we can't put it in the equity classification yet. So instead, we have to treat it as either trading or available for sale. Now, some companies will choose to put it in trading because they can track gains or losses through net income, but most companies put it into available for sale because they don't intend to sell it. So because of that, they don't want it in the trading portfolio. Of course, once it's in the available for sale portfolio, then we have to keep track of changes in market value. So just like we were doing before with our example of securities that have been transferred out of the equity classification, we now have to keep track of this portfolio and show increases in its value and decreases in its value in that unrealized increase-decrease account. As we continue to buy stock, we'll just keep putting it in that available for sale portfolio until we get to that 20% threshold for this subsidiary. Once we get to the 20% threshold, then step 2, we transfer it out of the available for sale portfolio and put it into an equity classification portfolio. Now, when we do that, we're going to record that transfer at the current market value on the day we got to that 20% threshold. And that's where this is going to affect retained earnings, because we'll have to show a gain or loss when we transfer these shares. Now, the change to retained earnings used to be even more explicit than this. It used to be that when we transferred from available for sale or trading into the equity classification, that we had to go back and figure out, well, what would we have done with this portfolio if we treated it as equity from the very beginning? And we'd have to do an adjusting entry that would change the value of the portfolio and directly change retained earnings. But in about 2014, FASB started what they called the simplification project. And as part of this project, they went through and simplified GAAP. Basically, what they were looking for was anything that was not really cost effective. So what they would do is go through and simplify the rules so that it didn't take companies so long to do the accounting. And this was one of those changes. Then, after that, we treat it as a normal equity security. So we keep track of any and all changes in the subsidiary's retained earnings. So let's take a look at an example of this so that we can see how it works. Acme Corporation has decided that they want to purchase a majority interest in PLE Incorporated, one of their suppliers. PLE currently has 250,000 shares of common stock issued and outstanding. Now, if we want to treat this as an equity security, remember, we have to own 20% of the shares outstanding. So that would mean that in order to treat this as an equity security, we would need to own 50,000 shares. But we're not able to purchase that many shares right up front. Instead, we can only get 25,000 at this $34 a share. So like many companies, we can't jump right into the equity classification. We're going to have to put this into an available for sale portfolio for now. Which brings us to step 1, which is to record the purchase and available for sale treatment. Now, if the company is able to buy 20% or more of the outstanding equity right up front, then we don't have to do steps 1 and 2. We just jump straight to step 3. We're not going to do that because we're trying to practice what happens when we are transferring into equity. So we need to practice steps 1 and 2. But for many companies that have a lot of cash on hand, it's one transaction. We own at least that 20%, and then we're done. In this case, we need to figure out how much cash we spent. So I take the 25,000 shares times the $34 a share, and that gives me the cash I spent, so we'll credit cash, $850,000. And we don't know anything about Acme's available for sale portfolios, but let's just assume they have, let's call it an expansion fund. Remember, we can name these anything we'd like. And this is to purchase 25,000 shares of PLE's common stock. And I'll make a note to myself. Let's see, 25,000 shares out of 250,000. I own 10%. So I'll make a note of that. This is 10% owned. Now that's all we have to do at the beginning of the year. During the year, we do have to take care of a couple of other entries. So we find out by December 31st, PLE had reported a gain of 650,000, which we would care about if this was equity classification, but we don't yet because we're still treating it as available for sale. We also find out that they paid a $100,000 dividend. We do care about that. And that the stock was trading at $32 a share. And we care about that because with our available for sale securities, we have to keep track of the change in market value. Let's start with the change in market value. $32 a share times 25,000 shares means that the market value is $800,000. I compare that with my historical cost, which was what I originally paid for it. And my value has dropped $50,000. Well, now I need a T account. I've got my expansion fund, which got a debit of $850,000. And I have a fair value adjustment account for this expansion fund. And we'll assume it's at 0 to begin with because we don't have any other information. We want the sum of these two accounts, this one and this one, to be $800,000. If I've got $850 over here, then I need a credit of $50,000. So that the sum of these two gives me that $800,000 market value. So to get from 0 to a credit of 50, I need a $50,000 credit, and that will be my journal entry. I'll credit fair value adjustment, expansion fund, $50,000. And I put it into unrealized, increase, decrease, expansion fund. And this is to adjust for market value. The other thing I need to account for is the dividend that they paid, $100,000. I own 10% of the company, so 10% of that dividend is mine. So we take 100,000 times 10%. That means that I'm getting cash of $10,000. But I don't know if I can put all of that in dividend revenue yet, because in order to know what goes into dividend revenue, I have to make sure that my cumulative excess of net income over dividends isn't negative. So I need to build a table. We have our year, we have our share of net income, our dividend, our excess of net income over dividend, and then a cumulative excess. So this is year one. Our share of net income, let's see, $650,000. We own 10%, so our share of net income would be $65,000. Our dividend we've already calculated is $10,000. So our excess of net income over dividends for this year is $55,000. And since this is our first year, that's our cumulative excess. And because it's positive, I don't have to worry about looking at book value or making an adjustment. I can just record all of the dividend as dividend revenue. So dividend revenue, 10,000. This is received dividend from PLE Incorporated. And that's all I need to do for step one. I would keep making these two entries each year until I cross the 20% threshold. So every year I'll check what's in the expansion fund, which will probably grow as I get closer to that 20% threshold, against the market value to see what I need to put in my fair value adjustment expansion fund to have the net amount of these two accounts be my market value. And then as they pay dividends, I'll check for a cumulative excess and I'll make a journal entry for my dividends. Step 2 is what happens when we reach that 20% threshold. So let's assume that on February 15th of year 2, Acme purchased an additional 90,000 shares of PLE's common stock. So let's see, I owned 25,000 shares. I've just purchased 90,000 more, so that's 115,000 shares. 115,000 over 250,000 means that I own 46% of PLE's common stock, which means that I've crossed the 20% threshold, but I haven't crossed the 50% threshold. I don't have to consolidate, which means I need to do step 2. And step 2 is the transfer to an equity classification. And there are two parts to this. First, I have to record the purchase of these 90,000 shares. 90,000 shares times $33 a share is almost $3 million, 2.97. So I'm going to credit cash for $2,970,000. And I'm going to debit the new equity investment account. We'll call it investment in PLE. And typically, once we've crossed that 20% threshold, we give each investment its own special account so that we can keep track of what's going on in its retained earnings account. Purchase of 90,000 shares of PLE common stock, 46% now owned. The last thing we need to do is we need to get the rest of the investment out of available for sale and into our equity account. So we're going to go back and take a look at the T account for our expansion fund. We have $850,000 in that account, and in this case we only made one purchase before. There could be 2 or 3 purchases, so we could have several pieces to this that we've got to figure out. In this case we've got $850, so I've got to get that out of the expansion fund. So let's start there. Expansion fund, $850,000. I'm going to transfer into the investment in PLE account at market value on the day that I cross the threshold. So that's $33 a share, and I own 25,000 shares. So 25,000 shares times 33 gives me $825,000. So into investment in PLE, I'm going to put 825,000, and the difference is either a gain or a loss. In this case, I need a debit, so it's a loss on transfer. $25,000, and this is to transfer original shares from available for sale to equity classification. And that's step 2. Step 3 is to do the normal entries for equity securities for the rest of the time we own it, or at least until we drop below that 20% threshold. So we need to do the journal entries for year 2, assuming that PLE reports a gain of $900,000 and a $300,000 dividend. Stock price on December 31st of year 2 is $37 a share. Please take a minute right now and do the 2 journal entries that are necessary to account for these 3 numbers for an equity security. As I mentioned before we faded out, we only need 2 journal entries, and here's what they look like. First off, we would debit our investment in PLE for $414. That's our 46% of this $900,000. Their retained earnings goes up. So since their retained earnings goes up, I record an increase to my asset because my asset is tracking my claim on that retained earnings. They also paid a dividend, so I'm going to get cash, again, 46% of the $300,000. That gives me the 138, debit to cash, but it credits my investment in PLE because it's going to drop the value of their retained earnings account when they pay a dividend, and I'm tracking that change. And now this, again, is going to affect my retained earnings because of this number right here that's going to be part of this year's net income and will flow through my closing entries into retained earnings. You'll notice two important things. One, I didn't do anything with the $37 a share. Now that it's classified as an equity investment, I don't care about market value. I'm tracking my share of their book value through their retained earnings account. So I don't care about market value. The other thing I haven't done is I haven't worried about the excess of net income over dividends. You see, these entries automatically take care of that already because I'm already accounting for my portion of their net income and my portion of their dividend. So since I'm already taking care of it, I don't have to do the table. Fun stuff, isn't it? All of these different pieces to tracking these changes to equity are so much fun because they have so many cool journal entries. Hopefully you're feeling comfortable with this third piece, changes to entity. Again, we're only talking about a very small portion that's in and out of equity. The more fun piece is consolidations that we'll leave to advanced accounting. When we come back in our next segment, we'll be talking about how we need to account for errors that are made in our accounting system and what we do with those errors. More fun journal entries to come. We'll see you then.